We're live. It says you are
Look
live.
at us go.
Check, check. This thing on?
I think you got it. It sounds good.
All right. I see numbers next to an eyeball.
That's
That means
perfect.
people are watching.
I think that is probably what that means.
All right. Welcome, everybody. At
It's
our first attempt, first recent attempt at a live stream.
I always think these are good. It's like a chance to connect with people a little more real time, especially when you're talking about some of this stuff. I always find, at least, it can be a little bit heavy up front. You got a couple people saying hello. We got EN and Turd Ferg. I don't know if there's anything better than reading people's handles. It reminds me of like when I used to play Xbox Live and everybody had the most ratchet names you can think of. That's what this looks like. It's awesome.
Well, Turd Ferg, he's a big friend of the show here.
Well, I'm a big fan of that name, so it all checks out. It makes total sense to me.
Oh, look at this. I didn't even know you could get comments. There's a whole comments thing. This is great.
Yeah.
Talk to us, folks. Yeah. Okay. So
Mr. Lauer.
We're here to talk about a few things today.
That seems to be the case. And really, I think you're more the guy that we have to talk to about a few things. Do we want to start with diving into inflation? Do we want to start with our tinfoil hats? Do we want to talk about markets? What's your vibe? Where do we start here?
Yeah, I feel like let's leave the tinfoil hat for later.
Smart.
Okay. Because I think I don't know if anyone really cares and wants to hear it, but we're going to go for that in a little bit. I think, why don't we start with markets, and then we'll get into some Fed talk, and then we can go a little tinfoily, right?
Love it. Markets is my space. Little bit of talking about Big Daddy J-Pow. Always have some time for that as well. So yeah, what are you seeing in markets so far this year? At least for me, has been it's a textbook year in a flow of volatility, in a flow of capital. That's like essentially what I've been looking at. There's a ton, at least from a trading opportunity, there's a lot of things that have worked really, really well this year. And from specifically an options trading perspective, it's the kind of year that you get to do a lot of different things in your skill set, right? So if we think before COVID, before 2020, you kind of had one trade to go with, right? It's stuff that's long. You got to go long. It's got to be long. And all your shorts, you get a little tiny tick and then you get stopped out. Not that fun. This year, you get the whole suite. You get you get to fade the real estate in the beginning of the year when it was crashing. You get to take NVIDIA up and become a gajillionaire in 14 seconds. I mean, it's essentially run of the mill.
Is there any other trade in markets but NVIDIA and Gamestop? That's like, I haven't seen anything else.
That's actually a really good question. I imagine those have got to be the most topical things, unless actually you go into the comment section on the YouTube channels and you'll find that the bots, the spam bots that show up and comment on themselves, they're really into this weird crypto token. Obviously, they're really,
obviously, for sure.
They think it's really good. Future. So I feel like I'm missing out.
I think you are. If you are not going all in on the bot crypto token, what are you even doing in markets, really?
I cannot think of a better use of my capital, literally at all.
I think so. Okay, here's what we saw yesterday. We saw NVIDIA past Microsoft. It's the world's most valuable company. NVIDIA's market cap over $3.3 trillion.
I think it's in terms of country GDPs, it's bigger than all but like the top 7. I think it's like fighting with France right now, if I'm not mistaken.
Fighting with France.
I literally, hold on. Let me not give you guys bad information.
Just imagine these cheese eating surrender monkeys, right? Like hunkered down and like you're flinging the semiconductors at them.
Yeah, I'm spot on. So,
just kidding. I love the French.
Well, when I went there, I told them I have like French heritage, and they still didn't like me very much when I was there. Very surprising to me.
They don't like anyone. That's,
Yeah,
I mean,
so
I mostly experience the French Canadian side of it, but they also don't like anyone.
That's fair. Oh, yes. My bad. It surpassed France. And now it's actually surpassed United Kingdom as well. And it's approaching India. So I think right now, NVIDIA market cap is like 3.34 T. India is 3.38 T. United Kingdom is 3.07, so they're light years in the dust. Entire country, never mind. And France got blown out of the water a while ago at 2.78 trillion. I mean, I don't even have time to talk about them at this point.
Yeah.
I mean, what do we? Yeah, you need at least another $1 trillion to even be in this conversation.
We talked about this on a recent Let's Talk Markets podcast where we didn't accommodate your time zone, but we were talking with George and Dennis, and it's hard to like reconcile. I mean, either you believe that this is the new industrial revolution, and Rex Smashington is saying Jensen's going to be the most powerful man on earth by the end of the year, and he really ain't far from it, right?
I tell you what, as soon as I saw him signing a girl's bra in a leather jacket, we're there. Like I don't know how to read that as a market indicator, but it's something. That is a big indication of something. The dude's a CEO of a company signing a bra. So yeah,
he's the CEO of a semiconductor company, right? This isn't like the CEO. This isn't Hugh Hefner, all right? He was the CEO, and you can imagine certainly him, right? But like, a semiconductor company, like this is a crazy new world. I'm sorry. So either we're in this massive bubble in which we've gotten way ahead of our skis, or it's the next industrial revolution. And I don't know. I honestly, I go back and forth on it from time to time. I struggle with it because I'm so kind of scarred from bubbles between like the .com bubble and the great financial crisis, and this isn't the same. If you look on a forward PE basis, right, it's clearly not the same. These companies aren't, not all of them, I should say. Some of them are pretty far ahead of them, but they're not. These companies are not necessarily at like .com level forward PEs, but they're pretty rich, and it's like they have to execute perfectly and satisfy this meteoric and expanding demand just to hit what they're valued at today, and that kind of thing makes me nervous.
I think it's a fair call out. The way I look at that stuff is there's kind of the hypothesis component, and then there's the traders component, as I talk about, right? And I break it down to the simplest concepts, really out of like a joke for stoicism. Stoicism as a typical practice where you take something, you break it down to its simplest thing, right? And when I think about the process of like trading markets, it's really important not to front run your ideas, in my opinion, because the prospects of like top ticking or bottom ticking things is very difficult. And that's a low probability way of kind of making money, I think. The way I think about it, especially for directional, it's follow things, what they're doing, and then pivot when they're not doing that thing anymore. Because if you take one stroll through Reddit and you go through something like the TQQQ's subreddit, there's tons of people that are like, oh, I thought it was too high, so I got out. And then, they got out and they just watched it go up another 40%, waiting for their pullback, right? From a trading perspective, to me, the market's very simple right now. Now, to your point, from kind of a forecasting perspective, it gets interesting, because I was actually talking with a buddy now about the difference that we're seeing in markets in these companies now compared to like the titans, the railroad companies back in the day, right? The titans.
Interesting. Yeah.
If you think about the difference in terms of what they're producing and what their markets are, railroads, ton of logistics involved, ton of materials involved.
Massive
NVIDIA,
CapEx. Massive. Yeah.
NVIDIA, obviously tons of logistics and materials, no doubt. But a lot of the tech space is being driven by stuff that moves differently than if you're trying to orchestrate moving a railroad across the country. I think that sometimes we get a little too stuck in what we consider to be fair valuations, unfair valuations. And to your point, I actually think the .com bubble is a really fair reference point, probably the only really good one that we have with this kind of industry. But even that, when you think about something like artificial intelligence, what do you think? The advent of the internet, probably slightly bigger impact. But artificial intelligence on a comparative scale, what do you think? Do you think it's about the same, way higher potential, not even close?
So it's funny. So I've spent a lot of time thinking about AI and evaluating sort of where we're at in the AI cycle. I've been through AI winters. Actually, worked in an AI lab in university, like in the year 2000, so literally 24 years ago.
Sure you
and
did.
we were building like evolutionary algorithms, which was relatively sophisticated at the time, and now looks like like addition and subtraction compared to like large language models. But I still think that the current state of AI is extremely overhyped. I think that these LLMs are limited in their potential, and they seem amazing, but they're good at some things, but they are not, to me, a step towards AGI, which is what people, like what is essentially being priced in, I think. And so I think that this is something, I do think AI could reach the level of impact of the internet or more. It could be in a new industrial revolution, but I think that we are not sort of on the precipice of that at the moment. I think people are going to be really disappointed, as they have been at almost every other past AI cycle, when reality, when the tire hits the road and reality sinks in, and you can't push past these model limitations. So, but like I could be wrong. Like I'm not, a scientist who's immersed in current research. I sit on the editorial board of the Journal of AI and Ethics. I tend to look at things more from a high level perspective than from like I'm programming transformers perspective. And if you ask Jan LeCun, who's the chief AI scientist at Facebook, he'll tell you, we're on the precipice of AGI, but like he's also using technology for horrific things and has been for many years. And so, I don't know that I would take what he says, because it's in his interest to represent it that way so that Meta's price keeps going up. And I like what Magnus here is saying in the comments, is that how hard it can be to scale up semiconductors. And my play here has actually been ASML rather than NVIDIA. I mean, I luckily I do own some NVIDIA, nothing crazy, but I think when you think about like the analogy to the railroads, it was always like buy the store that's selling the pickaxes and the jeans, right? And that's, to me, what ASML, TSMC represent. And so I've thought those to be much safer investments with more upside. Because if a competitor comes along to NVIDIA at the moment, they're going to need ASML. Whereas, like there is definite competition coming for NVIDIA. Like, how can there not be at this point? And AMD, Intel is they're driving hard to the basket, right?
So then a question for those in the chat is, you heard Dave's take, and what's your take? Do you guys think something like AI has the potential to outpace when we first saw the launch of the internet and the impact that had? I think the reason why that's such a relevant question is because when we go back to this conversation about valuations, it starts to either justify or not justify your perspective, depending on if we're thinking bubblicious or if we're thinking that we're essentially, like you're talking about, like a new dawn almost, where we're going to be waking up in the pod soon, having to pull the things out of the back of our heads because the machines have now got us all owned for energy. From YouTube, it says AI can't get the drive-through orders correct at McDonald's. Has a long way to go yet. It's a funny joke, actually. I think the problem, though, is whenever you're at the beginning of a technology, think of like the first cell phone. Remember the first car phone when those came out?
My dad had one. Yeah, it was literally, it had to be a car phone because you needed a car to take it around.
You needed a battery. Yeah, like they're ridiculous. So I think the idea, you can't base the perception of what it is off of those instances, although they're still pertinent and funny. But yeah, I think it's when thinking about the opportunity here, it extends way beyond that, at least in my opinion. Because if I think about the potential for things to scale massively, what's the last real accelerator that we've had similar to AI? And I can't.
I mean, I think you could probably say software in a broad sense.
Yep.
Right. Software, like if you look starting when, in the late 90s, for example, as it really revolutionized how we live and work, you look at productivity over time and you see just the wild increases in productivity that software in general has brought to us. In theory, I think that's like a microcosm of what you could expect from AI if it can realize its potential. But man, I think we've got a long way to go.
Yeah, I agree with that. And as we know, the markets are good at forecasting. That's what they're trying to do, at least, is front run some of the move until they forecast into obscene valuations, and then we plummet. And again, if you're a trader, nobody cares. You just trade it to the downside. You just do the old bait and switch. You're like, okay, it's all going down, so I'm going down too now. It looks like our boy Turd says, I think user data interfaces need to become cleaner first. AI is good at data out. In healthcare, it's already garbage in. AI will just streamline garbage out. I completely agree with that. And that's actually one of the industries I think AI has the potential to revolutionize the most, actually, is the health industry.
Healthcare, yeah. I totally agree. Yeah.
Think of if you can create systems that can analyze different biometric data of all these different patients and then the subsequent conditions, especially if you can interject something like genealogy, because we know genetic dispositions has a big thing, big seat at the table. Think of where that can go. You can essentially
you can already look at radiology as one area of healthcare that's being completely disrupted by AI. Like AI is better in general at many different not all, I'm not saying radiology generically, but the studies that I've seen in specific areas of radiology, like I think lung cancer was one study I remember seeing, and I don't remember. I want to say brain cancer, but I don't remember. Anyway, it's already outperforming humans, and so what I like to, of course, think about is not artificial intelligence, but intelligence augmentation, right? Because while maybe it can outperform humans, it's still going to make mistakes. Humans are going to make lots of mistakes. The two together, to me, that's the exciting thing. That's the exciting stage that we're at now. I think when I look at the market, I feel like it's pricing in that we're further along. That's it. That's all. That's the only thing that says bubble to me, is that we are assuming these systems are much more autonomous than they're going to be. And I was certainly I've been guilty of that too. I was sort of immersed in autonomous driving for a while, and I thought it was going to come much sooner than maybe now I think it will.
I have a bet with a buddy. It was literally, I think, back when we were in college. The bet's still alive now. I forgot the timeline that we picked, but he was on your side and I was the anti. I bet against it, that we would have full autonomous driving cars. I actually have to check in on that bet, because if I won already, I need to cash in on that. I don't even know what I'm supposed to win, but I just remember I took the null side of that bet. So
my bet was that I didn't think my daughter would ever need to get her driver's license.
Wow. So
and I don't know if I'm wrong yet. Won't know. I'm not going to, dox how old she is, but I've got some time still. But I'm still not necessarily convinced.
She will
probably now. Yeah, I think when I started to look at it, it was like 10 years down the road.
Yeah, I was going to say, unless she's an embryo that you guys are freezing, that you're going to fertilize 20 years down the line. And then maybe then maybe. But regardless of how old she
20
is.
years?
Yeah. Regardless of how old she is now, she's going to be driving. She might even still have to learn how to drive manual. That would be pretty sick. But we're losing that pretty fast. We're losing that too fast, I think. Good old manual transmissions.
Oh, man.
Rest in peace.
That's fun if you know what you're doing, and awful if you don't.
Let's take a look at the chat. We have a couple key-ins. Guy says there will be an interesting transition on what people will realistically pay for AI. Yes. Man, you want to talk about a topical thing? That is massive, especially comparing like the capabilities of that. Because like you guys have talked about, even from a YouTube perspective, right? For a while, I paid for like vidIQ, which is it's supposed to help you with like search engine optimization. Just learn how to make better content is the idea. And like their AI plugin was terrible. It was not good. It was supposed to help you come up with better titles and stuff like that. You would just like click, give me ideas, and they're terrible. So to your guys' point, for something at that price point, it was not a good product. So when I think about things like what people value and then what they're willing to pay for it, I think becomes a really interesting perspective, which leads me to my next question for you, Dave. Where do you think the near term, and I'm specific on that, the near term moneymaker is for AI, institutional side or individual human being side?
Good. I mean, yeah, no, I think it's the, like NVIDIA's data center business, that kind of, it's them selling to these,
B2B
firms that need giant trading clusters. Yeah, for sure, it's B2B. I think, I think we got a long way to go before you can get like into people's hands. Now I say this, and look what just came in the mail. I just got my rabbit. I don't know if you know what this is, but I got this from my kids. And
it looks like you're supposed to put it in like a Game Boy Color.
I know. I don't want to, and it's a mobile device, and it like tries to replace your phone with this, and it's all voice controlled. I mean, there's like a screen and a wheel and a button, but it's mainly supposed to be voice controlled and a way to interact with a large language model. And for certain things, like that's going to be awesome. Like my kid who, he asks a question, I always have the answer. But if I don't, I'll have to go Google it and open Firefox and blah, blah, blah. And now I'll just hit a button and be like, what's the answer to this question? Boom, get an answer. I mean, that's so cool. Right, for
that
to have access to something like that, right?
Like it literally revolutionizes everything. Think about what we value right now. There's a certain value that gets placed on expertise because you can only build expertise by X amount of time in something. And if you get to the point where, not that will ever fully replace expertise, because there is a bit of a feel portion of developing eminence in something, and that can't replace that, right? You still have to know what kinds of questions to ask. But the fact that you can get pretty dang close with just using a little machine like that, I mean, to me, like that is again, kind of like the start of this big change that I do think can revolutionize even the economy to a specific degree.
Yeah. And it's even at this point, it's affordable. Like this is not an expensive device. This isn't anything close to like your cell phone in terms of cost. And so, to me, I was like, when I was young, I was lucky enough that like my dad saw computing as the future, and he got me. I mean, I was on like an IBM XT and an Apple II GS, and I was learning to program when I was very young. And that set me for life on the direction that I ended up going. And like, I want my kids to have that same kind of exposure to this new type of tech, because I can't even imagine what they're going to come up with. So to me, it's like that generation, it's like the Gen Zs and the ones that come after them, that's where the real AI revolution will likely have to come from. You have to kind of grow up with new technology to really, I think, to realize like its true potential.
I think that's fair. I definitely think that's fair. I'm still hopeful that by the time I get old, we'll be able to cut off limbs and put on cybernetics, because it would be really sick to be able to like squat super heavy with like a implanted spine, some like cool legs, as compared to the
military. I thought you got exoskeletons and shit like that.
That's what I'm trying to get like an endoskeleton. I want to end. I don't want to have to. Yeah, I'm not trying to put it on. Yeah, exactly.
I just want a chip. I want a chip right here. And I just want all of the books that have ever been written on that chip and just access to it.
That's pretty good. That's pretty good. Access to a lot of old information, which I do think there's a lot of value in that.
Oh, you went right for the jugular on that one.
Yeah, for me, I think like doing that chip with like ChatGPT, whenever it's a little bit better though, because there's a couple times I've asked ChatGPT, and I got to be honest, I've never gotten more confident wrong answers in my life.
It's amazing.
Like
it's truly the best bullshit artist we've ever been.
Convincing. And in the beginning, when I was like developing a relationship with that, I wanted to understand if I could detect like how accurate it is so that I would know. So I was asking it questions about options, which I know quite a lot about at this point. And I mean, it literally gaslit me on like several. I literally went over to some of these other books and I was just like, have I had this wrong? And I was like, okay, I haven't. That's just a really convincing tool.
No, I know. I write a lot of comment letters, and I was like, this would be so amazing if this could help me write a comment letter better. It takes so much work to write a good comment letter. So I went in and I was like, I gave it a bunch of information. I'm like, can you write me a comment letter? And it was like, absolutely. And it wrote a great, you know, most of it was great. And I was like, okay, can you add specific citations to SEC enforcement cases on this topic? And it was like, absolutely. Here are 5 of them. And I was like, none of these
Please don't click on them.
Can you provide me a link to these? And it was like, absolutely. Here are 5 links to these 5 SEC enforcement actions. And it was like, absolutely not things that existed.
Perfect.
Like, this is, it really, it was like, this is,
listen, this is no good. It's such a good representation of humanity. There's so many bullshit artists out there. That's what ChatGPT is doing. That's what it's learning from, right?
It's what it's learning from, yeah.
You can't say you don't know things anymore. Otherwise, you're the dumb guy. I'm the only dumb guy I really know. I don't know a ton of stuff. But typically, you just make it up. You just get to say words, and then you off to the races.
Good, right? Yeah. All right. We came in to talk about the Fed. And then we said let's talk markets, but you know, actually we've been talking AI. So let's talk about the Fed. Let's spend a little time on the Fed.
Quick note before that, for everybody that's in the chat, we're hanging out for like another 20 minutes or so. So in the meantime, while we pivot over to kind of the inflation, if there's specific things you want us to hit on, throw it in the chat, and then we'll take a look at those while we're covering some of the inflation data, which I do think is really topical right now because it keeps shifting. So over to you, Dave, with the weather.
I'm going to add this here. Okay, I tweeted this morning. I said, what do you think has been the primary cause of inflation? So here's the poll. It's still running. You can go vote, but you know, it really settled pretty confidently on the Fed. And fiscal policy comes in second. Now, COVID supply chain disruptions is less than other, and I can tell you other was super interesting, very varied, but corporate greed was the absolutely the #1 thing on other. And now if we just jump over to another tweet from my past history, said,
but I want to protest a little bit on this poll because it would have been great to see if maybe there was like a poll is like, do you think inflation is transitory or not? Maybe like a little transitory or not inflation bit. That would have been great. But
it all depends what your definition of is. Jerk.
Okay, got it. So what, are we calling it transitory or not? I just want to make sure I know at this point.
It's pretty sticky right now. I'll give you that. It's pretty sticky. The surge was transitory, but we do seem to be stuck at around 3%. So yeah, it's hard to call it transitory. Eric's giving me a hard time because I came on his show the first time and I was like, oh, it's just transitory, nothing to worry about here. And you know, I mean Look, I think there's a lot that you can look at and say Team Transitory was right about a lot of things, but
inflation is gone now.
It's dropped, but it was harder than I think anyone thought it was going to be, and probably understated. So before we get to that, I just want to think. I want to talk about causes here, and this is something I tweeted before, and there was a study that came out that said 53% of inflation could be explained by corporate profits. And we heard on lots of earnings calls CEOs talking about pricing power, talking about their ability to raise prices especially in an inflationary environment. You can look back at shipping and energy costs as well. Obviously, like the war in Ukraine drove a huge amount of energy inflation, shipping issues through the Red Sea, right? So let's just call broad geopolitical causes as well, I think had a pretty substantial role in that. And maybe COVID supply chain disruptions was a bit too narrow. Maybe that should have simply been like geopolitical causes, including supply chain disruptions, which I think really played a foundational role. I think a lot of people want to jump to blaming the Fed, and I think that's they're an easy target.
Of course.
But and it's hard to argue against ZERP not having had a really foundational role in the subsequent inflation. I would argue that fiscal policy is probably the least responsible for anything in what we've seen. But some people did point out, I think pretty thoughtfully in the comments, that fiscal and monetary policy really went hand in hand. And you can have that kind of monetary policy of government spending and bailouts and all of that when you have money to print and when you're sort of monetizing your debt in the way we are. But this chart from Claudia Sam, I think really shows the dramatic sort of profit margin expansion that we saw, and which really, I think, played a really substantial role in what we've seen. Yeah, go ahead. Sorry.
No, I just wanted to give a shout out to whoever was saying that. You were saying that you were getting comments about the tie between fiscal and monetary policy, and like that's really perceptive of people, because I literally couldn't agree more with it. I think that to attempt to isolate one or the other, we like to try to have really simple explanations, right? This or that, and it's so rarely this or that. It very frequently is a combination thereof. So again, just shout out to whoever was coming up with that, because I literally think that's right on the money, genuinely.
Yeah, I'm with you on that one. And we did get a question on Twitter. Let me see what the actual question was.
Look at you go DJing all over the place.
I know. And he said, can you address why the metrics for inflation have changed so much? Normal people are feeling the pinch now more than ever before, but inflation is down. I think Wall Street and the Fed live in a different world. So I have looked into this in the past, and I will say one thing: that sort of part of this question is getting at this idea that our definition of CPI, the Consumer Price Index, has changed significantly over time. And now, when I looked at it, and I looked at most of the changes and substitutions over the past 20 years, they all seemed very reasonable to me. They all seemed like, look, the composition of the consumption basket is going to change over time, and you need to account for that. And then there's also what's called the substitution effect, which says that if something costs too much, if cupcakes cost too much, people go and buy cookies, for example, right? They substitute with something that's cheaper. And so it's not as straightforward as simply saying, well, this basket from the 60s, if we had held that consistent, inflation would be double or triple or 10x what it is today. It isn't that simple. But with that said, it's certainly true that people experience inflation in a more visceral way than policymakers and statisticians experience it in a chart.
Of course.
And it causes real pain, and that pain is traumatic, right? There's no way around it. Like when your paycheck stops going as far and it becomes harder to put food on the table, and a lot of people live paycheck to paycheck, like that's trauma that causes real pain. And so, as the Fed and Wall Street celebrates inflation, the rate of inflation coming down, it's still growing. Prices are still increasing. And even if wages are outpacing that growth, you still go to the grocery store and those eggs still cost like a crazy, like butter still costs these wild amounts that like 5 years ago you would never have thought possible. And so even if your wages are increasing, you would have hoped that wage increase would like bring you a better life, and instead it's like you're just swimming in place if you're lucky, right? I think that's how a lot of people feel. And so, but there was one significant change to the way of calculating inflation, and that was to switch from using housing prices to using owner equivalent rent. And Larry Summers, who to me, that's sort of a dirty word, that name, but I'll cite him for a moment to say he did do a study that looked back and said, what if we had used owner equivalent rent historically? And he found that inflation was very muted by using this particular value, whereas for a long time we had been using mortgage prices or home prices. And so if we were to use home prices, like that's a pretty substantial difference here that we're seeing in the rate of inflation, right? You're talking like well over 11% in 2022 at the height of the inflation as opposed to 8%. That's a big difference.
Quick question on that though. When it says using owner's equivalent rent, do you know what's included in that figure?
So owner's equivalent rent, which has become the primary driver of inflation today, along with auto insurance, which is weird. But if you look at if you dig into the inflation numbers, the two main sources of price inflation are those two things. Owner equivalent rent.
Who needs insurance? Just whatever.
And auto insurance is an interesting one, right? Like it costs more to fix cars now because of all the chips. So we're right back to semiconductors.
Yeah.
So NVIDIA is driving your auto insurance.
NVIDIA.
Yeah. So soon they're going to start offering auto insurance and they're going to produce more sophisticated chips. It's like this virtuous cycle, and then it's going to be worth $100 trillion. So you heard it here first, folks.
But yeah, so do you know what's included? The reason why I'm asking is I'm curious if it's just kind of standard pricing, or is that figure also including like the upkeep, the taxes, like those kinds of things?
So I believe
that's a big difference.
Owner equivalent rent says that if you own your house and you decided to rent a house at that same type of house, this is the equivalent you would pay in rent. And it looks at the change in that. So it's not actually something that a monetary thing people experience. It's like an economic thing in the ether, essentially.
Yeah. It's because again, whoever made this is clearly smarter than I am, so I wouldn't, tackle their work at all. But I think that's
they're an economist. I wouldn't go that far, Eric.
Yeah, but to me at least, I do think that that's a bit of a miss if it is just that, because part of, for example, like the price you pay to rent a property is one thing, but then the overall cost as the owner of that house renting it, it's not the same thing. It's not equal to the rent I receive.
No. It's absolutely not.
So to me,
that perspective, right? If you were to use housing prices, inflation would be much higher. Right?
And I'm not sure that home prices is the right either. I actually think it would be really interesting to see like a owner's equivalent rent that includes cost to carry the property. Because you think of like the process of trying to manage your property, the services you have to get if you're not there to do it yourself, or if you do it yourself and you have to go get materials, prices on lumber's up, like that kind of stuff.
For sure. And the cost of everything is going up. Yeah.
Exactly.
And, with interest rates going up, even the cost to carry a mortgage obviously is going to shift for a lot of people. Although, in the US, most people locked in a pretty low 30-year rate, which is, a globally unique thing. It's not, you don't find that all over the place. And Pink, good point. We'll link back to our macro and markets episode where we had Claudia Sahm explaining all of this. So if you're interested in a much more intelligent explanation than I'm able to provide, we'll get Claudia, who is just an amazingly talented communicator of complicated economic concepts, spent some time on a recent episode of our podcast, Let's Talk Markets, talking about all of these issues. So, let me take a second to say, hey, subscribe to our YouTube channel if you're not already, Irvin Finance on YouTube. Check out our podcast, which comes out on a regular basis. We've always got, I think, some great content across our channels, and we get great feedback on it, lots of fans, and we always try and respond to your questions and criticisms too. All right, this is interesting comment here. I'm a railroader, just retired, and from YouTube, I'm a railroader. During the pandemic, Union Pacific raised their shipping prices on their customers twice, while railroad profits were already through the roof. Again, getting back to corporate greed and exploiting the situation. And you saw this across shipping, right? Shipping was crazy. Railroads, cargo vessels. It was just what is it like the Baltic Dry Index? That just went nuts during the pandemic. It was wild. And you had, backups at all the ports and everything. I mean, those were like these wildly complex sort of price impacts across the economy.
Yeah, and the interesting part about those is it's exactly what you're talking about, at least as far as I can see, where a lot of them, they'll use the justification of, oh, everything's more expensive for us. But then as things get more cheaper than us, I probably would bet the prices aren't going to magically get lowered. That's my guess.
Yeah. Yeah, that's right.
Obviously, I stayed somewhat. Sorry, go ahead.
Oh yeah, no, finish the thought. I was gonna switch.
No, let's switch. Bring the pain.
So, all right, let's talk about what all this means, right? So what's the Fed gonna do? This is from the CME Fed Watch tool. So this takes all of the interest rate futures contracts and it aggregates them into what the sentiment actually is by Fed meeting date on what interest rates are going to look like. And this has just been something I've been watching for a while now, because it's fascinating to watch the market adjust to what the Fed says. And so yesterday we had a bunch of different Fed speeches. Austin Goolsbee, Adriana Kugler, Alberto Musalem, Susan Collins, Thomas Barkin, and Lori Logan. So all these different Fed presidents and governors spoke yesterday. And, there was, as like a TLDR, there's a lot of optimism about the state of the economy, very little fear of recession, which is a big change of pace from the start of the year. But there was consensus that the time's not quite right for interest rate cuts, and they're not really ready to say if or when those cuts might occur. And if there was just a Fed meeting in June 12th, and the estimate came out that just one rate cut was likely to occur in 2024. And that's what we see here. Although with like that recent inflation print, we're starting to see that maybe by December we're going to get a second rate cut, right? So that's what this chart is saying, is that the July meeting, 88.6% chance that we hold tight. But by the September meeting, the market now thinks there's 72% chance of a 25 basis point cut. And certainly by November, an 88% chance of that cut. And then by December, maybe even an additional 25 basis point cut. So the market thinks there are going to be two cuts this year. I came into the year thinking 3 to 4. Now I think 2 is maybe a little optimistic, frankly.
Completely agree. When I started the year, I originally repositioned a lot of my trades specifically because my original hypothesis were the cuts were going to come later. And then as I was watching the bond market, and I saw bond markets pricing in, at least towards the end of last year, they were pricing in cuts as early as the summer, late spring, summer of this year. And I was just like, whoa, I need to at least be positioned if that's the case. Otherwise, I'm going to be, really late to the party. So then I started positioning the portfolio to take advantage of that. And then it got kicked out. And so to me, I have to imagine the market is still over emphasizing the cuts, especially if we look at the probability, at least in my opinion, of the Fed cutting 2 meetings in succession is probably very low. I can't imagine a world where the Fed would want to do that as compared to cut, see how things go, and then make a decision. Because one of the worst possible things they could do here, cut too fast, and then we have a new problem that emerges. AKA inflation starts spiking back up. That becomes really problematic because we're running out of tools at that point to stifle it. So my guess is that the Fed is still probably going to maintain alongside their message and pretty much slow roll it. That's what I'm expecting to see, at least so far, based on how they've been running. And even if you look at the markets, they have been wrong so far, like just straight up in terms of their assessment of the cuts so far this year, especially if you look back over the history of this tool. And again, you can look historically in the bond markets to see what they were pricing.
Yeah, I think that's pretty accurate. I do think that it would be unlikely for them to cut twice in a row. But at the same time, you are, and we've got some dog noise here, so I'll apologize. We're going a little long, and but that's okay. So I think that when you look globally, you do start to see that other central banks are cutting. And Canada has cut. I think the EU has cut, or was it the UK? And so the US does risk sort of being left behind in the cutting cycle. So I do think that we're close to one, but more than one would surprise me. But what do I know? I mean, like, the market clearly thinks that we've got 2 coming. And so, generally the market is pretty good at this kind of thing.
The issue, again, the only thing I would highlight again at that is the market's been wrong this entire year so far on it. They thought the first cut was going to be last month.
It's
right?
true.
It's like,
yeah. I mean, even before that, it thought it was the market was sure it was coming in March, right? Like
literally dead wrong. So
the market has been consistently wrong. That's a good point.
To me, I think that is actually an example where the market seems to have been overplaying their hand a bit. And I think it's way too optimistic. And the other thing, again, from a trading perspective, I just think everybody is trying to front run this move. Because when it does start to happen, in my opinion, it's probably going to be pretty quick. So I think folks are trying not to get left behind.
That's a bit of what we're seeing here.
Yeah, that's exactly my guess right now.
I think that's a really good point. It's funny to see that come out in this way, but the idea that there's going to be another cut this year, which is against what the Fed is saying, and unlikely given the stickiness of inflation being evidence that people are trying to get ahead of it. That's a good point. I think that's really insightful. All right. So I think we're going to wrap it up here. Anything else you wanted to talk about?
No, I think
my dogs.
Yeah, I think overall the conversation, main thing to kind of synopsize a lot of it is a lot of uncertainty. We have tech running super hot. We have NVIDIA literally dragging the entire market up with it, whether it wants to go or not.
Screaming, yeah.
We have massive distribution of net highs, lows. We have a conflict of interest with respect to what we think the cut is going to look like potentially. Fed is still messaging probably one, and they're still essentially saying we're moving slow. The market's saying I want to by the end of the year. So there's just a lot up in the air right now. So I think for people, it's really important to stay sensitive to what the markets are showing us, not what you think is going to happen, because what we think doesn't matter. It can be part of our thesis, of course. The market's going to do whatever the market wants to do.
Okay, you know what though? I know we're supposed to go, and it's okay. I think we're okay back here. We did say at the end we get a little tinfoily, and we didn't.
Yo, let's break them out.
We didn't get to do that. So yeah, let's real quick.
I was trying to look for something that could be a tinfoil.
What if your smart helmet?
Right? That I've actually tried to put it on. It doesn't fit at all. Apparently the hoplites had very small heads. Yeah. I don't know what it is. I think it's mostly just thick bone, because my head doesn't fit much, bro.
All right. So yeah, I don't have any. I don't see anything. I don't know.
Next time we'll
a little stone cutter. What about the stone cutters? Right.
That's pretty sick. I like that.
Cool.
Yeah, right? that could be our mascot.
Yeah, and the dude is right here. You see in the background on the top of the bookcase. There's the dude. He's got his rug. He's on his rug.
Good question. Is that a bookcase or is that just a stack of books?
No, it's like a fan. It's actually a nice bookcase. Yeah.
Okay, so it's a case.
My favorite books. Oh,
I was curious if you were just dropping like a book Jenga. That's what I was thinking it might have been. Yeah. So tinfoil hat, I think one of the main front run questions I see is this world around FTDs, the potential for there to be a cyclicality to them and the potential impact to the markets. Do you have an opinion at a high level of that?
So yeah, FTDs and FTD cycles. I'm gonna table that because we're gonna bring on. We've spoken with John Welborn, a professor at Dartmouth, who knows this stuff way better than I do, and I'm gonna just say, let's get him on next time to talk about that. That's what we really wanted to sort of. Yeah, we want to talk about it. We want to address it. A lot of people are confused or just interested in what this can possibly mean and what these cycles mean. And I'm not going to pretend to know enough about it. I know that, there are these settlement cycles at play. I don't know that, there's a ton there, but it's not really, it's not really my area.
Which is fair, but don't forget, this is tinfoil hats. We're not responsible for anything we say here. This is,
and there's all sorts of stuff going on with XRT.
Speculation.
Yeah, and it's crazy. Like clearly XRT is being used in a certain way where it's got massive failures to deliver. It's got crazy high short interest, and it has been on the reg show threshold list. I think we said something like 1,700 days, and that was the last time we talked about it. And I haven't been paying attention, but I assume it's been on there since. But maybe not. But it's it's really something quite crazy is going on. And I think people that deny it, you don't have much of a leg to stand on it. I think people probably think that there's more there than there actually is, but again, I don't know. And this is the only thing I can say. The thing I wanted to talk about though, you and I talked about Roaring Kitty's options position. We talked about what we thought was going to happen. I actually think we were speculating a bit, but we kind of nailed it. We did.
Of course, you're speculating. This is all speculation. It's impossible to know. For anybody that thinks that anybody could know what happened, they are straight up lying. Again,
I agree with that.
I tell you, we really need to get the right kit for this part. We need like a straight up tinfoil hat so that everybody knows we are just talking out of our ass.
Let's say he exercised his options.
He didn't.
All right.
He didn't, but okay.
Okay. But actually it matters because of this tinfoil. Okay, here's the tinfoil.
Now, see, guys, you guys are welcome. It took me a minute to get Dave into the tinfoil hat mindset, but we are entering.
Did he come into this with a plan to exercise the options or not? Okay, to me, that's the question. And here's sort of, to me, the game theory around it, right? So, okay, if he came in planning on exercising the options and potentially creating a gamma ramp. Maybe he wanted to do that. Maybe he didn't. But if he came into this thinking, I'm going to exercise the options, if that was his plan all along, at some point, the stock was so high that he could have exercised the most of, if not the entire position. And he didn't.
Correct.
He didn't. So,
correct.
If he was always going to exercise, in what world do you not exercise him at that point?
To me, it could be based on a slightly larger thesis he might have had. It could be based on the timing of the exercise. That's one of...
You think that? Yeah, I've seen that. I've seen that on Reddit. I've seen people talk about that. Yep.
I haven't, to be honest. I don't know what the prevailing thesis is there, but to me, based on the movements I see him make, and again, I let everybody know, I traded the event that we saw, what was it, 21, and then I traded this event because it pops up on option scanners for me, but I'm mostly trading as it pops up as I see it. I'm nowhere near as read into a lot of this as other people. So I put that out there because some people are like really deep on all of this stuff, and I respect the level of depth that they have. But anyways, when I look across some of what I've seen him do, it's clearly not purely for money, in my opinion, right? There's obviously some departures from that. So part of me thinks part of the calculus that he has is disruption, making movements that potentially can disrupt. And the other guess that I have is I don't know how the equity offering impacted his decision cycle. That's the other component that I'm unsure of.
That's where I get the final layer of my tinfoil, in that I think he was caught off guard by the offering. And I think
so too.
The pressure, the downward pressure that put on the stock derailed his plans, and he had to adjust on the fly. And so I think that's what we saw. Here's the other, of course. Here's the other part to that though that I'm curious about. His position now is only
9,001,000 shares only.
Yep.
He has more money in the account. He could have had a bigger position if he wanted.
Yes.
So when I see him buy 120,000 of the 20 calls, my opinion, exercising all of them was not part of the plan, even from the jump. That doesn't seem like the case at all. He didn't have the capital in the account. And the fact that what we see his position at now, even though he had more money to use if he so chose, and he didn't, it looked like he had a specific position in mind. That's my guess.
Okay, interesting. So you think he had a target, He drove to the target. Everything like that this is his plan unfolding mostly as he expected.
I think loosely. Yep. I think that the prospects of him making more money on the short call or on the long calls is here or there. I'm sure, who wouldn't like that. But I don't think it's a mistake, clearly, that he landed at 9,001,000 shares, very specific number. And also, he still has more capital in the account. He's like over $3 million. I think it's like 3.6 or something the last I saw. He could have bought quite a bit more if he was so inclined. So he landed on that number very purposefully. I think somebody told me that was like the number of shares Ryan Cohen had like a while ago. I don't know what his position is now. Yeah, but yeah, to me, there could be a correlation there. That's one of the reasons why I'm so infatuated with this whole thing, is because the lore is unbeatable. It is absolutely crazy.
He literally is memeing with his position.
Yeah. Now, Turtford says same amount as RC. Yep. I think the only problem with that is pre-post split, or I guess equity offering and then split, because I think that there's do we know what Ryan Cohen's position is right now? Because I've heard some people say it's the same. I've heard other people say it's much larger now.
Oh yeah, no, he has continued to buy in.
Okay.
And I think we're close with it to his cost basis where we're at right now.
Got it.
In terms of where it's trading. Let me see if I can quickly.
Yeah, because that would be an interesting benchmark as well. Like everything that I've seen so far from Roaring Kitty, it's funny because he puts on a facade of shaking a magic 8 ball and like playing games, right? He's having a blast. He literally is so entertaining. But you could very clearly tell that there is a clear plan, a very clear plan that dude is executing.
Yeah, I see 36.8 million shares owned by Ryan Cohen.
Okay. So then the last question, I know that it's about time for you to go, but why the 9,001,000 shares? I haven't seen a good answer to that yet that I fully on board with.
Well, I mean, I think that's the point was, pre-split, that was Ryan Cohen's initial position. So even though it doesn't match post-split, there's at least some meaning to that number.
But what's the meaning?
Just that it's like a call out to Ryan Cohen's original buy-in, which was really what set up all of this.
That part I'm following for sure. But why? Okay. What's the reason behind it? Why the call out?
Why do that? Why call out? Yeah.
Yes. Why? Damn it.
Why? I guess. Yeah.
I tell you what.
Why not?
That's exactly what we need the audience for.
I'm gonna throw this weight around, and I'm gonna show you that nothing matters, and I can put on like this crazy sized trade and still meme it up even in the trade. That's pretty badass. Come on, right?
Pretty entertaining. Scott says, so did he sell his contracts to buy shares? That's the assumption. And then Scott says, didn't RK's cost basis not go down? It would have if he exercised the 20 strikes. So what we found out is I think it's the E-Trade platform. And again, this is kind of more normal anyways, is that they do use strike plus premium in there.
In the cost basis. Yeah, so it would have gone up if he exercised.
The tricky part anyways is that if I have a video out that I went through all of the math, if that scenario played out, and it's still not accurate, it still doesn't line up perfectly.
Yeah,
but
I saw
it won't line up perfectly because if you have 120,000 contracts, you have an average basis, $5.60, whatever it was. I can't remember. But the point being is that's an average. So that means some of those contracts were above that, some of that were below that. We don't know out of that 120,000 which contracts were exercised at what basis, but we do know that the residual 4,001,000 shares comes out to like $26 a share ish on his existing position. We know that, but we can't tell exactly how he got there. Now, based on the options volume that we saw, and based on the position as it's laid out, and based on the lineup with the market prices at those levels, it does look like, at least in my best opinion so far, that he did sell and then buy the shares. That's my best guess.
Okay.
Because one other thing, sorry.
Yeah.
There was still like 30 cents of time value left in those calls. That doesn't sound like a whole lot. But if you do that on 120,000 contracts, it's well over $3 million that just would have been gone if he chose to exercise, just poof, gone. And some people brought up the counter argument, fair, about the tax considerations.
Tax implications, yeah.
It does not seem like this dude is super focused on tax considerations. Again, because if that's the case, you don't buy 120,000. You know you're not going to exercise them. You know that the majority of them you're going to sell and scoop up, again, your 9,001,000 shares. That's not a mistake of a number. So you exercise what? A small subset of those contracts, a third of the total position. I don't think he's super concerned about taxes. That's not what I see there. But again, pure speculation, and it's super important to reemphasize, nobody can know. You literally cannot know. There's no way to clearly decipher based on the information we have.
Except for Roaring Kitty. He knows.
Except for
maybe he'll let us know. All right. So we just hit an hour. We're going to cut it at a clean hour. It was supposed to be 45 minutes. I'm going to get some grief for that. That's okay.
I hope you get flogged.
Yeah. Great conversation. I really enjoyed this. Really, thank you everyone who joined. We just got excellent engagement and questions. It's been, we've been reading every one of them. Really appreciate it. Again, we're going to try and do this on a somewhat regular basis. We're going to try and get, more informative videos out there, because I think a lot of people like to consume information this way. And we are going to get our friend of the show, John Welborn, like I said, on soon to talk about FTDs and these different settlement cycles. Scott, you're asking, can this be rewatched? Yes, this will be on our YouTube channel. We're going to get it posted up quickly. So again, thanks everyone for joining us. We'll hopefully see you soon on Irvin Finance. Go to irvin.finance. There's great conversations happening in the communities there. Great tool for researching stocks and and engaging with other investors in the companies that you are a shareholder in. We have verified shareholder communities, and we have effectively solved the bot problem. So get onto irvin.finance and check it out. Check out our YouTube channel. Eric from ES Invest, check out his YouTube channel. Always a source of great information and options market insight. So Eric, thanks again for helping us and for joining us today.
Glad to be the idiot in the room.
All right. Thanks, everyone. Have a great day. Stay cool. It's hot out there. And we'll catch you next time.
See you guys.